Hi everybody. In this video, let us see what are preliminary expenses and how are they treated and why do we treat that as an asset. So, preliminary expenses are expenses which are incurred before incorporation or registration of a company. It includes legal charges, registration charges, charges for printing and distributing memorandum of association, etc. Section 35D of Income Tax Act 1961 allows a deduction of 1 by 5th of such expenses in a financial year. It means this has to be amortized over 5 years. It means in India, 20% of preliminary expenses can be written off in a financial year. If we had spent 1000 rupees prior to incorporation of our organization, definitely we will be showing 1000 rupees as preliminary expenses in balance sheet. At the end of this financial year, we will be writing off 20% of it. At the end of 5th year, preliminary expenses balance becomes 0 because 20% of 1000 rupees is 200 rupees. Every year we will be writing off 200 rupees. Now let us see why do we consider preliminary expense as an asset. So an asset is anything from which future economic benefit is expected, right? Similarly, from preliminary expenses, how do we expect future economic benefit? It forms an important question. So preliminary expenses are expenses which are incurred for registering a company. So once the company is registered, it is going to be active till its winding up. So the registration is valid till the winding up of a company, right? So it is for a quite long period of time. Unless we are a registered company, we can't run a business legally. We can't enter into contracts. We can't claim benefit from many government schemes. That's why a registration of a company is necessary to run a business legally. So from all these reasons, preliminary expenses are considered as an asset. Now let me show you the accounting treatment of preliminary expenses. Assume we have a cash balance of 5000 and capital of 5000, and we have incurred preliminary expenses of 100 rupees prior to incorporation. The journal entry would be as follows: preliminary expenses account debit to cash account. Now look at the balance sheet. Cash is reduced by 100 rupees and preliminary expenses balance has come to 100. Totally balance sheet is matching. And let us assume we have written off 1 by 5th of this expense in this accounting period. The journal entry would be as follows: preliminary expenses written off account debit to preliminary expenses account. Now come to P&L. So this is shown here and total loss has come to 20 rupees. It is reflected in balance sheet also, and preliminary expenses balance is reduced by 20 rupees because we have written off it. Similarly, this is carried till 5th year. Then preliminary expenses balance would come to 0. So this is how we treat preliminary expenses.